Hey, what's going on, Cashflow hackers? It's Chris with Life 180, and welcome back to the Whole Life Insurance Masterclass with Life 180. And last video, we talked about the 5 different ways that you can utilize whole life insurance in your life to help you accomplish your financial goals. Talked a lot about starting with the end in mind, reverse engineering the process to get there, the hierarchy of financial needs. Hopefully, you're starting to really wrap your head around the idea of the importance of structure, the importance of leading with our values and beliefs, thinking about what our core values are. I think a lot of times when I say that, and I've done videos on this recently in other areas, talking about aligning your money with your values and beliefs, sometimes that kind of seems like an ambiguous concept or statement. And so getting really, really clear about your core values, getting clear about the vision that you have for your life and what your mission is for your life and what your purpose is for your life, it's kind of the foundational starting point here. So once again, if you haven't done that yet, go down in the link in the description below. Make sure you get the download of the free workbook, the Values and Beliefs workbook that we have with Life 180. Make sure you go through that, check it out. I think it'll help you. Now, since we talked last video about 5 different ways that you can utilize whole life insurance, today in this video, I want to talk about the fact that if you wait, there's a huge cost of waiting, right? So if you haven't watched the previous video on the 5 different ways and gone through the emergency fund, opportunity fund, the living benefits, the volatility buffer, the legacy planning, all the different things that we talk about and how whole life insurance grows with you, then obviously you start to, if you haven't watched it, go watch it. But if you have watched it, you start to understand, man, I want to start doing this as soon as possible. A lot of times people think, oh, I'm going to wait. Now, I've shared my story. My wife got a traumatic brain injury, and she's not even insurable. The life insurance companies, we're still about 4 years out of having an ability to go through a process to be able to get her life insurance again, right? My father-in-law I have my story with him. I've shared those stories. I'm not going to share them again in this video, but the bottom line, I think what I want to do in this video is I want to show you the actual cost of waiting. So what I did is I put together, you can see on the board back here, I've got a bunch of different illustrations. What I'm going to do is I'm going to go through every age from 25, 35, 45, 55, and 65 years old. So every decade, basically break it down and show you what it looks like for a $12,000 a year premium. So you have clarity on, what it looks like. Because I get a lot of people that reach out to me and they're like, hey, Chris, I'm 65 years old or I'm 55 years old, but I've got kids. Maybe I should do a policy on them because the cash value is going to be better. Well, I'll cover why I don't think that's necessarily always a good idea, especially if you're insurable. I'm a big believer that you got to get the insurance on your own life for a lot of different reasons, and I'll cover that. But without further ado, let's just hop into it. I'm going to share my screen and we will talk about this stuff. So you can see here, I went across here. You got 25-year-old, 35-year-old, 45, 55, 65, right? So what I'm going to do is I'm just going to bounce across this really quickly so you get some clarity on what it looks like. Full transparency, what we have here is a $12,000 annualized premium. I've made every policy the same. The only difference is we're getting older, 26, 36, right? So it's an older decade. So you can see a 35-year-old on the top here. We've got a 25-year-old right here. Now, that said, we're going $12,000 a year in premium. You can see that it drops down to $2,400. Down here, it drops to $2,400. The number in between is a little bit different, $11,762 versus $11,853. I'm going to explain what all this means as we go through here. But let's just do this. So $12,000 in premium. You can see with that $12,000 in premium here, you have a $9,918 net cash value, meaning this is the amount of money that you have liquid and accessible. Well, about 95% of that money liquid and accessible in case you need it for emergency. When we talk about building an emergency fund, right? As that emergency fund grows and you're 25 years old, it's going to become an opportunity fund, right? You start having 50, 70, 80, $100,000. You can utilize this to invest in real estate, to invest in business, for private money lending, whatever you decide is right for you. I'm going to zoom in a little bit more. But on top of this now, you can see here when we talk about, a lot of people say whole life insurance is expensive. I've already addressed this, right? Whole life insurance is not expensive in comparison to term life insurance, because a lot of people would say, well, just go get term life insurance and spend $1,000 a year instead of $12,000. Well, if I spend $1,000 a year for 10 years, I'm spending $10,000. If I'm doing $12,000 a year and at the end of 10 years, I have $134,000 of cash value, I'm actually ahead. So what is the actual cost, right? That's the difference. We gotta stop thinking about cost and start thinking about value, start thinking about what our overall goals are. So at 25 years old here, this is why I'm a big believer. If everybody could get a whole life policy when they were a juvenile, when they were a kid, and their parents would do it for them, the world would be a different place. If the second best thing is as soon as you graduated college, this is the first thing that people did, it would change the complete dynamic of our economy in the United States within 20 years. The whole way our economy would function would shift. And so if you're a parent and you're watching this, I really encourage you to think about this for your kids. But we're doing this net cash value. Now, what I want to do, I've explained this to the 25-year-old. As I go through, you can pause, you can look at the numbers. I'm not going to spend a lot of time breaking those down. The purpose of this video is talking about the cost of waiting. You can see here for $12,000 a year, you have this liquidity, which is, it's over 80% liquidity out of the gate, and you're ahead at year 10. You've put in $120,000 in premium, you've got $134,000 of cash value, plus you have a death benefit still there, and this death benefit is guaranteed to keep growing, okay? That's something to understand. Now, at 36 years old, you can see that because of the age, because of some of the variables and the MEC rules and the calculations, this is a weird anomaly, and you'll notice why. But at 12,000, same thing. You actually have a little less liquidity, but you actually get more death benefit here. That has to do with the term insurance rider and the way it works and the way the MEC rules are, the way that the system kicked it out. That I was actually surprised to see that, because usually the older you get, the less death benefit you get. And this starts to show, case in point, at 46 years old, you can see here $12,000 net cash value, and you're going to start to see what I'm talking about. You'll notice that the cash value doesn't go down very much. The net cash value, the liquidity year one when you design the policy properly. What happens is the death benefit goes down. That's because the MEC calculations and how much cash liquidity you can put into a policy and the way the PUAs work, paid up additions work, it takes age into part of the equation. So the older you get, the less life insurance you have to have. A lot of IUL agents like to talk about this as the corridor, and they like to make it sound like it's exclusive to IUL, but the reality is it works for whole life insurance as well, because the MEC calculation allows you to have less life insurance for the same amount of cash value. That makes, at least from a liquidity perspective, as long as you're healthy, it makes it so having the money in your policy can actually make sense. And once again, if you're healthy, I just believe you got to have, well, first of all, the insurance company is going to make you have insurance on yourself before getting insurance on your kid. And so I'm a big believer you should just do that. Now at 56, you can see the same thing. You're losing a little liquidity, but not a whole lot. And you got $176,000 of death benefit, and it goes down. But once again, at year 10, you can see, compared to the 25-year-old who had $134,000 at year 10, the 25-year-old also at year 10, you'll notice had $534,000, so an extra couple $100,000 death benefit. That's going to be the big difference, not the liquidity. But I do believe there's value in this death benefit, and obviously the fact that the mortality risk for a 56-year-old is much greater to the insurance company than a 25-year-old. And if you have kids or whatever, I would say that I'm just a big believer. You should have that insurance on yourself from a legacy perspective, right? From a accomplishing a goals perspective. Now, what I do want to notate here for everybody is, as we're going through this, you'll notice that the 25-year-old, I used a 20-year term rider. What happens is, you could see it's $12,000 a year for 20 years, and then it drops off. The MEC rules allow us to put a little more money in. You'll notice that the $12,000 drops to $11,853. The reason that happens is because if you go $12,000 minus $11,853, that's $147. My guess is, and we'll look at this later, is that it's $147 in term rider. That 20-year term rider was $147 a year. That's what it is. Now, the MEC calculation makes it so all we can do is go down and pay the base insurance from that point forward. So you cannot contractually put any more money than this in. But you'll notice we're able to fund this at 25 years old at much higher levels on a much cheaper basis for a longer period of time, which is going to equal higher death benefit, more paid up additions, more dividends paid, and higher cash value that you can utilize this money for an opportunity fund, for real estate, all these things. At 36, you could see we're able to do the same thing, but you can't extend it for the extra 5 years. You can only do it for 2 years. It drops down to $2,400. The cash value you could see and the death benefit are just less because A, you're funding it for shorter periods of time, and the cost of insurance is a little higher. Now, when we hit 46, we did a 15-year term rider. The reason is because you can see here the term rider, it gets more expensive because of the fact that you're older. And so plus, if we insure for 20 years instead of 15 years, you could see the 15-year term rider ends at 60. If we had done a 20-year term rider, it would have gone through 65. So once again, the longer the term rider lasts on a guaranteed basis in your life, the more risk there is to the insurance company, the more that term rider, this actual cost of, in this situation, it was $276. That $276, if we had extended it from a 15-year to a 20-year, would have gotten more expensive. So we want to make sure that we're keeping those term rider costs as low as possible. And once again, you can see that you're still ahead. You put in 120, you got 132. By year 20, you've put in 219 and you got 322. So it's, once again, this isn't sexy, it's a bond alternative, right? We're looking at this as a bond alternative where you're 30, you've put in 243 and you got $510,000. And so this is a bond alternative that from a 30-year period, it's gonna outperform the bond market and it's gonna give a lower standard deviation. So look at it as a bond alternative, as a volatility buffer in your life. At 56, you can see I changed the term rider to a 10-year term rider because of the cost of insurance. And we're just trying to manage this. But once again, even at 56, at year 10, you're still ahead of what you've contributed. And this is where it gets a little trickier. We can do life insurance at 66 years old. We can still have a high percentage of liquidity. But once again, our funding capacity is going to be restricted a little bit. We're not going to be able to put in the $12,000 a year. We used a 7-year term rider. And this is super important for older people because not every company is able to do a 7-year term rider. If we were 66 and had to do a 10-year term rider, it would be super expensive because guaranteeing a death benefit into age 75, the mortality risk for the insurance company is extremely high. And so therefore the risk is not really what they're looking for, right? So, but you can see here, even though the numbers are a little different because we had to change some variables because of the older person, you got to take some different variables into consideration. We're starting with the $12,000, but we're only able to pay that $12,000 for 7 years. And even with that 7-year term rider being as low as possible, you could see it's $609, the $12,000 minus $11,391, $609 per year for the term insurance, right? Even on a smaller death benefit. So there's less benefit, more expense. Now, that said, you're still coming out ahead of what just buying term would be. You got $100,000 in total premium and $108,000 of death benefit. Now, once again, or of cash value. Once again, though, you can see here that it's a savings account with ancillary benefits, right? Now, a lot of people would say, well, why would I want to keep my money in a whole life policy? Well, if you believe you want to have safe, liquid, accessible capital, what are your options? You could go do a CD, you could do a bond, you could do a savings account, because this has got money market-like liquidity, muni bond-like tax treatment, and bond-like returns. You're going to have this $108,000, but the real leverage point is the fact that this is going to be tax-free, like a muni bond, and you're going to have this extra piece of leverage, the gap, the 152 minus the 108. So you've put in 100, you basically picked up a 50% leverage play for the death benefit there on a tax-free basis. So if anything does happen, well, it's not life-changing, it is self-completing to a certain extent. It's really going to help you, right? So this is the real difference, right? Like when you start younger, you have different reasons that you're starting, you have different goals, different objectives, and the reasons that people buy these different policies at different stages of life are to solve different problems. So remember, if you haven't watched it yet, the first video we did is thinking about what are the problems that you're trying to solve. The second video was the hierarchy of financial needs, really getting clear about your financial structure. Last video we talked about the 5 different ways that you can utilize whole life insurance, or the best ways, I should say, to use whole life insurance. And now I'm showing you this to kind of bring it into perspective about why starting young is important. So now what I want to do is I want to go to the next slide, and we're just taking the story down the road a little bit longer, right? So now you can see this is page 2 of this ledger. So the 25-year-old, you could see here, this is the power. The 25-year-old in this scenario, check this out. by the time the 25-year-old has gotten to 60 years old, right here, they've put in a total of $323,000. They have $783,000 of net cash value, and they have a locked-in guaranteed, or not guaranteed, it's current assumptions, but it's about as guaranteed as a non-guaranteed asset will ever perform, especially at today's dividend scale of 5.2%. If dividends go up, this number can actually get better. If dividends go down, then this number will get worse. So it's just something to think about. You got to understand the variables that come into play, right? But this 5.2% number is the lowest it's been in 80 years. So it's something to consider that I don't think they're going down much more, especially since dividend rates have gone up and interest rates have gone up, and typically dividend rates will chase interest rates higher as they go higher, okay? And so that's something to consider. So as we look at this net cash value, when we think about, all right, what did this 25-year-old, they went through life, they had all this cash value to operate as an opportunity fund. Maybe they bought a business, maybe they did real estate, maybe they did private money lending, maybe they did something of that nature. But then they hit 65, they've got this money recapitalized in their account, and now what do they have? They want to retire, they want to be completely cash flowing, they want to be financially free and start thinking about what they want this policy to do for them. And it depends on really what the rest of their assets look like. If they're performing strong and they've got good cash flow, maybe they don't need to tap into this. But maybe they use this as a volatility buffer on negatively performing years. They can tap into it. Or maybe they just say, hey, everything else is good. I've got this massive legacy play. Once again, that I'm aligning my money with my values and beliefs. I've started with the end in mind. I've gotten really clear about what I want to do. And so wouldn't it be cool if at 90 years old that I've pretty much got this almost $3 million, potentially even $3 million if dividend rates go higher and come off their 80-year lows? Wouldn't it be cool if this actually were here, that I had this whole system set up to pass on? Now, I could do that for all the same cash flow at 25 years old. If I wait till I'm 36, look at what the results are at 90. At 90, we're saying the same thing. It's 1.689 million. So like basically 1.7 million, right? At 90, I'm gonna highlight this actually. I'm gonna go here. At 90 years old, we have 1.689 million. And at 90 years old here, we have 2.8 million. So by waiting a decade, you've not only cost yourself opportunity and not had the emergency fund and opportunity fund and all these different things, but you've basically cost yourself $1.2 million in potential legacy at 90 years old to the next generation, right? So I really want people to think about this. Now, if you wait till you're 46, from 45, from 25 to 45, you go from 2.8 million to 962,000. So you cost yourself almost $2 million. In fact, you still cost yourself waiting from 35 to 45. The potential legacy play difference here is from 1.6 million to 962,000. It's $700,000 difference waiting from 35 to 45, right? And if you wait from 45 to 55 at 90, you can see this, you can see where this is going. You're at 472,000, you cost yourself another 500,000. And once again, so you could see where this is going. And if you start at 66, you cost yourself 700,000 from starting at 45 because of the fact that you just have no leverage, right? The risk is just not worth it to the insurance company. And so when we look at these things and when we look at the different variables that come into play, starting as young as possible has a ton of value. If you want to insulate and guarantee a result for the legacy of your family, if you've started with the end in mind and you know that you want to create this system and not just have the money, but have a set of rules and a trust and all these things set up, I would say reach out and we can help you, because this is like one of my favorite phrases. The best time to plant a tree was 30 years ago. Why? Because you could harvest a tree. Why? The best time to start a policy would have been 30 years ago if you're 45, right? When you were 15 years old, if your parents had started for you 20 years ago, maybe at 25, you could see the benefits. If you had started at 25 compared to 45, that would have been the best time. Well, the next best time to plant that tree, to start a policy, is right now, because if you wait, it's just going to get worse and worse and worse. And that's just the reality of the scenario. So now it comes down to, no matter what happens when we're looking at this, I'm gonna go through, this is just the last extension of like past 100 years old. I'm not gonna spend a lot of time on that. The other thing about this is that I'm not gonna spend a lot of time on this, but the living benefits are huge, right? I'm a big believer in having living benefits and utilizing the living benefits. If you become critically, chronically, or terminally ill, you have access to this money while in either lump sums or periodic advancements of payments. you have access to this amount of capital based on acceleration of a partial acceleration of the death benefit. You have ability to utilize this money for different medical needs, right? So when you start off at 25 years old, what happens is this money builds and it builds and it builds. And so, you know, I say my father-in-law, we got his policy when he was 65, but he got cancer when he was 73. And so obviously the benefit was smaller, right? But if he had started when he was younger and he had funded it the way we talked, not only would he have all this cash value, but he'd have the ability to accelerate and have leverage, you know, for $945,000. Now, does he need that much for medical bills? Maybe, maybe not. I don't know. But you can see as you go through here, it's going to follow suit with everything we just talked about in regards to cash value, to net death benefits, and all the different things that we have going on. But your value just gets smaller and smaller and smaller. Now, there's still value in doing it. There's still value in having this benefit. But once again, the purpose of this video is to show you the actual cost of waiting, right? So when we start thinking about the fact that what we're doing here is we're getting $1, each dollar, to perform multiple functions. As we are 25 and 35, and we're starting in our younger years, we have this emergency fund that we're building up. We're building our financial foundation. We're protecting our families. Once that's capitalized, we have our opportunity fund. We're going back to the hierarchy of financial needs. We're going to use this opportunity fund to do real estate investment. We're going to do business. We're going to do private money lending. We're going to do whatever our unique skills and abilities have us, you know, able to do. We're going to have living benefits, and then we're going to be able to focus on legacy. So when we have the ability to have this dollar to perform multiple functions, why would we not do that as soon as possible, right? Why would we not have that done, considering the fact that we have a high percentage of liquidity in these policies as we go through here, right? Like, that's what this is all about. Like, the actual cost of the policy isn't, from a cash flow perspective, isn't as bad as a lot of people would have you think. So once again, we got to stop asking about cost and start asking about value. So this is what to think about here. At 25 years old, this is the premium amounts that people in this example would be locked into. $12,000 a year is the first annual premium, and then minimum required annual premium after that would be $2,666. So there's flexibility in between these two numbers right here. I think that's important to understand. Now, what this gets you as a base policy is at $65,000, we're paying for $150,000 of term insurance, right? That $150,000 of term insurance, like I said, was $147. And then you could see for the 35-year-old, you got the base goes down to 53. The term rider goes up. That term rider has a higher cost. But once again, you're flexible between these two numbers. The minimum is going to be a little higher because you're a little older, right? So it's something to consider. As you hit 45, we're dealing with the same thing. $276 for the term, which goes up from the $238 before. The base we're going to keep the same because we're doing the same blend. $12,000 premium, $2,700 minimum, still about the same. At 55, the minimum goes to $2,900. The base is $12,000, or the first year premium is $12,000. But you can see the term rider goes more expensive, and so that's it's going to be the same thing here. The base is a little higher, or the base is the minimum, I should say, is a little higher. First year annual premium is still $12,000. Cost of the term rider is really the difference in the expense and the actual cost of that base insurance, and what it gets you from a coverage perspective is going to be less and less. So you can see total insurance purchased is small. Total insurance purchased is a little bigger as we get younger, and it just keeps getting bigger and bigger and bigger, right, as far as these numbers go. At the end of the day, what we need to be thinking about, as I said, is focusing on value, not cost. We need to think about the cost of waiting and just really figure out, from your perspective, core values, what's the vision for your life, what do you have as a mission for your life, what do you want your legacy to be. We have whole life insurance that is, to me, the most powerful and flexible asset on the face of the earth because of the fact that it will get each dollar to perform multiple functions. And with that dollar, it can perform and grow with you as you age, solving different problems at different stages of your life. And to me, no other asset in the world will do that for you. And I've shown you here what it looks like with the cost of waiting. And if that doesn't hit home and make you realize that if you haven't done this yet, you really need to consider getting started for yourself. It's not gonna kill me if you don't do it, but if you wanna optimize generationally, being able to pass on and make this impact, there's no better way to do it than what I'm showing you right now. So if you have any questions, go down in the comment section, leave questions. I'm happy to engage, answer questions, do all that stuff. And if you want, set up a call with somebody on the team. We can set up a clarity call with a certified Life 180 coach, and they will guide you through all this, and they will get you access to the Values and Beliefs workbook. That is part of our whole process. We're not just about selling life insurance. We're about helping you get really intentional about your values and your beliefs, helping you get clear on your core values, what your vision is, what your mission is, and then aligning your money and utilizing money as a tool to help you accomplish everything that you're set out to accomplish. So hopefully you found value in that. This is an extremely important video. Next video, we're gonna land the plane a little bit and talk about how this stuff actually works and how to actually utilize a whole life insurance policy to create more opportunity, to create more efficiency in your life. So make sure if you haven't already, you're subscribed and you hit the bell. That way you're notified when that video comes out. We'll see you there. Have a blessed, inspirational day.